This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the podcast, I have Justin Fox. Justin is the executive editor, New York, at the Harvard Business Review Group. He's the author of The Myth of the Rational Market. What a fantastic, fantastic story threading through the 20th century. The rational market academics, the behavioral academics, the whole story threading through to today. Just awesome stuff. Very cool. I hope you enjoy. Your book, The Myth of the Rational Market, a few years old, but there's nothing in it that's dated. I have to say, from a historical perspective, it's fascinating to watch the progression and the yin and the yang and the ideological back and forth between, let's say, the rational camp and then what started in the 70s with, let's say, the behavioral camp. Just a fascinating subject. I'm extremely jealous of the access you had. There's a couple guys in your book that I've had a chance to sit down with, Vernon Smith, Harry Markowitz. I've talked with Daniel Kahneman on my podcast, and I've had a chance to meet with several traders that worked at Commodities Corporation. So, you know, your book is right there in my world too. So I'm jealous of the access you had.
Well, you got to talk to Kahneman. I remember when I was working on the book, he had just won the Nobel, and he was like, send me an email, which I did.
Well, yeah, I guess I got him a few years after all the buzz. Listen, let me jump in with, as I mentioned, having a chance to meet Harry Markowitz, and it was later on. It was 4 or 5 years ago, but you could just see that glimmer in his eyes of a very, very wise man, astute in math and statistics. But I thought was interesting you actually go back even earlier than Markowitz, but I thought Markowitz was a good jumping in point, and that Harry was keen to point out what we should do, but it was the camp that came after him that assumed what Harry said we should do that we were all doing.
Right. Which was sort of an amazing leap.
Right. Why don't you map out a little bit of a quick and dirty on Harry Markowitz? That kind of doesn't sound right, quick and dirty, but why don't you map out a little bit on Harry Markowitz, Nobel Prize winner, and then kind of explain that jump?
Sure. Well, and I've been thinking a lot more about Harry lately and meaning to go talk to him again because as I'm sort of understanding the whole story of the rise of kind of Bayesian statistics and the Bayesian way of approaching the world. It turns out Harry's a sort of early battler in that, although he kind of gave up. And so the story here is he's this young guy going super fast. I think he got his undergraduate degree at Chicago in 2 years, went straight into the PhD program, going super fast to a PhD program. And he's sort of the prototype of today's quants. His main classes he was taking were in things like decision theory and linear programming and statistics and the like. And the people he was taking them from were a bunch of people who were now legendary, Nobel Prize winners, and Jimmy Savage, who isn't super well known in the wider world, but is actually one of the most important figures in statistical and probability theory in the 20th century. And so what Markowitz, he was perfectly trained to, how do you think quantitatively? How do you make smart decisions in an uncertain world using quantitative tools? And he wasn't saying anything about, how the world worked. He was simply saying, okay, I'm an individual and I don't know exactly what's going to happen. And it turned out it was the stock market that he ended up writing his dissertation on. But I do have this idea of the range of things that could happen. So what is the way that I should behave? And that was his dissertation, his famous article in the Journal of Finance, I guess, in the early 50s on portfolio theory. And that's kind of modern portfolio theory grew out of that. And his whole argument was, you couldn't say exactly where a particular stock was going, but you could say something about, you'd make a guess. You couldn't be certain about it. And you could, at the same time, quantify your range of uncertainty. And what's really interesting is that he saw this as this almost this personal thing that you would do. In the late 50s, he was advising a brokerage firm that wanted to see if they could put some of his research to work. And his whole thinking was what the analysts at the brokerage firm should be doing is, making their estimates of how much a company is going to earn or where its stock's going to go, and then going back a few months later and seeing how far off they'd been. And over time, calculating sort of the range of uncertainty around their forecasts so that they could then make more rational decisions. And the reaction he got was this was this small firm where the CEO was also an analyst. And people were like, well, no way are we going to go back and check whether the CEO's forecasts were right or not. So no, sorry, we're not going to do this. And so that was sort of Markowitz's first attempt to go out and have people use his ideas in a practical way. Ran up against, nobody on Wall Street wanted to do it that way. He went out to Rand in Southern California and was creating computer programming languages and having nothing to do with financial markets, while a bunch of people at MIT and at the University of Chicago and at UCLA and a couple other places were building this whole worldview in which markets were almost perfectly efficient, and in general, investors as a group, not necessarily individually, but as a group, behaved as if they were really smart, really rational decision makers looking out into the future. And so then that's where this idea of, let's assume a world where everybody behaves in sort of the quantitative statistical way that Markowitz tells people to. How would that world work? And that's where Bill Sharpe came up with his capital asset pricing model. And that's really where that sort of finance worldview that came out of the 60s and 70s and really took the world by storm in the 80s, and is still out there, although clearly people understand that it's not quite right anymore. That's where that came from.
Yeah, that jump is amazing, isn't it?
Yeah, and I mean, Sharpe is one of my favorite people, and I probably talked to him more than anybody else in the process of the book. He was very supportive of the whole project and is somebody who's constantly sort of examining his own past decisions and thinking about them. And, his argument is just, I was a grad student looking for a PhD topic. And this just seemed like, what he initially did. He'd had a PhD topic on transfer pricing, I think, and some new faculty member came in at UCLA. That's where Sharpe was, and was the world's expert on transfer pricing, and said, there's nothing new in this PhD. You should do something else. So Sharpe, totally distraught, is sent by another professor at UCLA to go visit this guy at Rand, Harry Markowitz, who had written a couple of interesting papers 10 years before. And Markowitz said, well, one thing I'd always been wanting to figure out is, my method of thinking about the correlations between different investments is you basically have to calculate the correlations between every single pair, if you're looking at the stock market, every single pair of stocks out there to figure out an efficient portfolio. And at that point, that just took obscene amounts of computer time, which was really expensive in the early 60s. And so he says, he's thinking, a problem that would be nice to solve is there a simplified way to do that? And Sharpe came up with this idea of beta, which is just you calculate a stock's volatility relative to the overall market. And that gets you most of what you're looking for when you're trying to figure out the correlations in your portfolio. And so he, initially calculated that as, okay, here's this simplified method. And he's like, well, if I'm doing a PhD in economics, I probably got to say something about equilibrium and how markets work. So I'll try turning it around, saying, what if everybody did this? And he actually initially got rejected when he sent that section of the dissertation off to the Journal of Finance because it was so wildly unrealistic. And he wrote this whole letter back citing this famous Milton Friedman paper from late 40s or early 50s, where Friedman had argued that, it's not how realistic the assumptions in an economic model are. They're always going to be unrealistic. The whole point is you're oversimplifying the world. It's whether it makes useful predictions. And so Sharpe wrote back, well, let's just see if this thing is any good and is useful. And the article got accepted, and CAPM sort of became the standard way of thinking about risk in financial markets. And definitely the early tests in the late 60s, early 70s, mostly seemed to show it to be pretty effective. Since then, there have been a lot of issues with it, the main one being that stocks with low betas, not very volatile stocks, actually do much better than the theory says they should. And then, of course, there are tons of other market anomalies, as the finance professors call them, from value to momentum to a bunch of other things.
To watch the progression, the kind of the timeline, and it's almost like a tennis match watching the good professors volley back and forth. But you mentioned once Harry's work kind of got out there in the stratosphere, that some professors, Chicago, MIT, and I was thinking of MIT, and I mentioned this at the very beginning, Commodities Corporation. So you have Paul Samuelson at MIT, and you might want to explain how he expanded. But I think what's so interesting about him is here is a guy that, and correct me if I'm wrong, but was all about the rational market. Then here he is setting up Commodities Corporation with essentially quants trading price-only trend-following models in the 1970s.
Well, yeah, it's ironic. I mean, the thing about Samuelson is he's sort of the great economic theorist of the second half of the 20th century, at least in sort of academic economic terms. What he did, first of all, is just took a lot of ideas that were sort of floating out there in economics and put them into mathematical terms, made much clearer what people were trying to say. And so, when he wrote a paper in the 60s that basically made the argument that a market in which everyone was rationally anticipating the future would be a random market, an unpredictable market. And it's really funny. There's this whole thing at the end of the paper where he says, I'm not saying this really describes how the market is. I'm not saying this is a good thing. I'm not really saying anything. I just, followed my formulas where they took me. So he was somebody who, at the level of his academic work, was pretty, austere, rational economic man. But as soon as he started talking about the world and how it worked, and you can get this from his famous textbook, which was the dominant undergraduate economics textbook for a few decades, starting in the late 40s, he didn't ever think the world actually adhered to his mathematical model. So in that sense, it's not quite as crazy and surprising as you think. I mean, the other thing that happened is it wasn't the plan for Commodities Corp to be the kind of trend-following trading operation that it was. It was initially supposed to be...
It was fundamentally driven.
What's that?
It was fundamentally driven when they started.
Right. It was Paul Kuttner, who was another MIT professor, who was this... He believed that markets... he wrote he edited this famous compilation about random walks in stock prices in the early 60s, and he was part of the random walk group, but never believed that it was perfectly random. He thought there were ways you could do better than the market. And yes, he was the driving force initially, and it was going to all be fundamentals. I think they got, I don't remember the exact circumstances, but they were getting close to being wiped out. And a couple of the sort of more practical people they'd hired to help them with the trading said, hey, try this. And it worked. And it turned into this, pioneering, trend following.
One of the guys that I would have loved to have interviewed there was Amos Hostetter, who died in a car accident, I believe, in the 70s. And he was the senior deacon of the quant style there, and he had a quote that I love, and it was something to the effect that if he lost 25%, he said, "Never mind the cheese, just let me out of the trap." And I just love that. There's so many things little things that I found that he wrote that I just like, oh, this would have been such a cool guy to interview. And let me shift gears on you. It's a really dense subject, and folks should definitely check out The Myth of the Rational Market. In the 1970s. Things start to change, so to speak, right. Or at least the debate sharpens, or maybe the debate sharpens just a new way of thinking. This behavioral mindset starts to unfold.
Well, yeah, and it comes from, there's sort of two different directions. One is Eugene Fama, the originator of the efficient market hypothesis, had sort of set it up as it's a hypothesis, let's test it. And people did. And by the mid to late 70s, they were starting to find more and more things that didn't really fit this sort of it was the joint hypothesis, Fama called it, of markets are efficient, meaning there isn't any easy money out there and prices are more or less right. And the only way you can know if prices are right is you need a theory of what prices should be. And that was the capital asset pricing model. So most of these tests were sort of trying to test the two together. And so you had all these tests, and either the efficient market or CAPM or both was starting to fail them in little bits. And even Fama was doing these tests and getting these results. And then at the same time, coming from a completely different direction, you had Daniel Kahneman and Amos Tversky, these psychologists who had been spending the 70s doing a whole bunch of interesting experiments about how people actually make decisions about the future, and finding all of these pretty consistent deviations from kind of the rational model that people like Harry Markowitz and his mentor Jimmy Savage and John von Neumann and others had put together at mid-century. So, and the person who brought the two people who brought the two worlds together were Bob Shiller at Yale, who just won the Nobel, and Richard Thaler, who's now at the University of Chicago. He was initially at Rochester, then Cornell, and has been at Chicago for the past 10 or 15 years. And so, Shiller came to this purely by kind of testing whether markets are efficient and finding that they were much more volatile than any reasonable forecast of future dividends would be. Thaler came to this from just asking people questions about money questions and getting really inconsistent responses depending how you ask the question. And so that led to this whole explosion of research in the 80s. And what's interesting is in the 80s, it was this very contentious thing. I mean, Shiller had his famous remark that the efficient market hypothesis was one of the most remarkable errors in the history of economic thought. And Robert Merton, who was a rational market guy, wrote a bunch of papers dragging Shiller and his methods over the coals. And at some point in the 90s, it all kind of settled down, but they didn't really tell the outside world. Because I did this really interesting interview with John Campbell at Harvard, and John Campbell is sort of the guy in between. He was a student of Shiller's in the 80s at Yale and did a bunch of work on market inefficiency with Shiller, but then he ended up expanding on a lot of Fama's work, co-authoring stuff with Fama's son-in-law, John Cochran. And you talk to him about his view of markets, and it's in this in-between place. It's like, yeah, they're sort of rational, sort of irrational. They're sort of efficient, sort of inefficient. And it's kind of funny because it seems like all they've done is, after this decades of argument and millions of words and equations printed in various academic journals, they've landed at this pretty common sense place where it's like, well, yeah, they're no totally easy pickings, but at the same time, clearly people have to be able to make money in markets or they wouldn't keep coming to them. It's always, I go back and forth whether, all the people in economics describe this as this great forward progress of economic science. For an outsider, sometimes it looks like just a bunch of people running around in circles for decades on end.
Yeah, it kind of looks like some academics having fun debating each other and maybe
Right.
not seeing the obvious in front of them. And I tell you what, you bring these examples up in the book, and you can kind of cover them how you might like. But how did the academics respond and start to think about the success that guys like Warren Buffett, Ed Thorpe, the Commodities Corp guys? How are the academics responding to some of these guys that were consistently doing really, really well in the markets?
Well, one way to think of that is that part of what started the whole random walk academic movement in the late 50s and early 60s that then led to this whole efficient market capital asset pricing model worldview was that in the 50s, chart reading was really popular. It was sort of this big new, it wasn't really new, but I think it got a mass following for the first time. And, a lot of these, it was just people. One of the main guys at the time was just sitting in an office in Springfield, Massachusetts, didn't have much mathematical training, didn't know much about statistics. He would just draw charts and say, oh, those look like repeating patterns. And a lot of this work was spectacularly unsophisticated, and a lot of it was totally bogus. Some of it wasn't. But Harry Roberts, a statistics professor at Chicago, wrote maybe the paper that more than any other got the whole random walk movement going, just pointing out that, it's pretty easy just with random series to generate charts with patterns that look like they're significant. And what you need to be doing is trying to give statistical tests to these things and maybe be looking at whether there are patterns in price changes rather than just patterns in overall prices. And so basically the early reaction was, okay, here's all these people out in the market saying that there's this way to make money, and we think they're full of it. And then in the 60s, there was the whole go-go mutual fund movement and this obsession with performance. The critique from Sharpe and many others in academia was, we think most of these people who are making 50% gains a year, all they're doing is taking on huge amounts of risk. They're buying high beta stocks, and it's going to come crashing to earth. And sure enough, it came crashing to earth. It was only later, like in the 70s, that they started noticing, well, there are a handful of people like this Buffett guy who I think the world started taking notice of sometime in the mid to late 70s. And Ed Thorpe, who again, I think the Wall Street Journal first wrote a big article about him in about 74, although a lot of the academic finance people were already aware of him because they'd sort of gotten wind of the fact that he'd figured out the Black-Scholes option pricing model before Black and Scholes did. And, and Thorpe, both Buffett and Thorpe were people who, when they talked about how they did what they did, it didn't sound like they were running some scam. The academics who listened to them had to admit, okay, these guys are, these are actual smart, rational people. Maybe they're onto something. So I think, early on, you read the early reactions of people like Sharpe and Samuelson to the success of Buffett or Thorpe. And what they say is, well, yeah, you'd expect there'd be this small minority of people who actually do know how to do it. That it's, I think Sharpe called Buffett a 5 sigma event, like this statistically vanishingly likely thing. And it was only as all these professors started doing more and more research on market anomalies that they started deciding to jump into the markets too. And that's something that began happening in a big way in the 80s, that more and more of these people, even at Chicago and definitely at MIT, started either leaving completely to go work at Goldman Sachs or Salomon Brothers, like Fisher Black and Myron Scholes, or setting up little hedge funds on the side. And that naturally changed their views about how the world worked to some extent.
It's terribly interesting. It's just not a subject that, the average investor out there that maybe tunes into CNBC. I mean, I'm not saying it's you got to be interested, but your book, The Myth of the Rational Market, is dense. I mean, you got to sit down and say, okay, I'm going to dig into this. But if somebody wants to understand the depth and how this has progressed from even back to the early 1900s, it's really a nice piece. I mean, I commend you on it. It's kind of cool. I definitely will be reading it again because there's so much detail in there.
Yeah, I went back and forth on how much detail to have. Like there were times early on where I thought, should I just pick 5 people and write about them? But then at the point I was writing it, I didn't know there was going to be a financial crisis. I didn't know there was a chance in a million years that my book would be a bestseller. And I thought, well, the only, obvious audience for it is maybe business schools and real finance wonks, and they're going to want the whole story, not just selective tales of 5 people. I went through it several times, like, okay, do I really have to have this person's name in the book somewhere? And a lot of very smart and good people got lopped off, but there were still tons of them. Yeah. A little hard to keep track because there's so many. Because I wanted to track the idea, not necessarily the people.
So I won't necessarily, it's not giving away anything, but there's a passage in the book where Shiller talks about that well-designed markets and well-informed investors, regardless, are prone to manias and panics. And so you're kind of thinking about, well, how does financial innovation occur? And he he talks about flying, and he kind of compares it to flying. And he said, well, at one point in time, we had a lot of plane crashes, and, things obviously have gotten better over time. So he gives a very optimistic tone that these situations, which I ultimately, my personal opinion is human nature is human nature. We're going to have crashes and bubbles, and they're not going to stop. I remember Vernon Smith telling me, here's a guy who won the Nobel Prize. He said, we don't have any idea why these bubbles happen. They just do. And
right.
But I thought it was interesting how you put that story with Shiller in your book, because you didn't really inject yourself into the book. But I thought the way that you put that passage in there, you were kind of disagreeing with him, I thought, even though you didn't say that. Am I completely off base? You were less optimistic than he was, that there was that all these insights.
I guess what it is it's clear that whenever there's a bubble and then a bad crash, there are bubbles sometimes that fizzle away and it's not a big deal. But when there's a bubble and a bad crash, there's usually some financial innovation at the heart of it that people hadn't figured out how to use safely just yet. On the other hand, usually then after a couple of crashes, people figure out the right way to design it and the right way to interact with each other. And that particular thing isn't going to cause any more crashes. Although very often, regulation always ends up focusing on what caused the last crash. And so that tends not to be very helpful. Yeah, I'm really in the world of, it's clear that we've had this world with much more rapid financial innovation over the past, 30 or 40 years. And there have been positive things to that. There have clearly been negative ones too. It's a world with more market volatility, with definitely more bubbles and crashes than were happening for the 40 or 50 years before, when financial innovation was totally constrained. The reason we left that era of really tight regulation and really constrained innovation is that it wasn't coping very well with a changing world. We had the Federal Reserve telling banks and savings banks how much they could pay in interest, and suddenly the inflation rate was higher than what they were allowed to pay in interest. And that just wasn't tenable. But clearly the regulatory apparatus is not adaptable enough to deal with that. So we had this big change because tightly restricting innovation didn't, worked for a while, but it can't work forever because the world changes. And so, I do think maybe we're fated to swing back and forth between kind of constraining financial markets and letting them go wherever they're going to go. It's sort of an interesting question now because financial markets have become pretty global and governments, are still very national. And so any attempt to rein them in is much more complicated than it was in the 1930s and 1940s. So I guess it's less that I disagree with Shiller than I find it surprising that a guy who focuses so much on how markets go wrong is still such a believer that more markets is the solution to all of our problems. On the other hand, when you listen to the specific things that he talks about, you sort of get the reasoning. One of the things with stocks that causes, I think, is sort of crucial for why they get into bubbles a lot is that unlike with options and a lot of other financial instruments, there's no set endpoint. You can sort of convince yourself forever that something is worth something. And, there's no moment like with an option when suddenly, well, it's worth what it's worth. You're exercising it this day and that's what it's worth. And so Shiller, one of the things he's talked about is, well, what if you divided stocks into like annual claims on dividends? So you could buy a stock that just gave you a claim on a company's dividends in 2017 and that's it. And his argument is, well, that would focus people a little more on the fundamental reality underlying what's going on. And, that would change how they think about buying that stock or selling that stock. And it would bring more rationality into the market. My thought is it would also just confuse the heck out of people. But, that's his argument, and I have some sympathy with that.
I don't recall it completely, but I believe it was Amos Tversky, and he was sat at a table with a rational econ
with Mike
professor.
Jensen.
Okay. Yeah. And they got to talking, and it was the individuals versus the group, the individuals making errors and the group getting it right. Could you just relay that really quick? I thought that was a really kind of just fun way of outlining the whole debate, so to speak.
Right. And this was, a secondhand story. Basically, Tversky died before I started working on the book. And Jensen, he didn't remember it, but he said it sounded pretty much like him. But a couple other people who were at the table, Jensen had said right around the time of this dinner in a paper that gets quoted all the time that the efficient market hypothesis is basically the proposition in economics with the most empirical backup. It's the best theory in all of economics. And Tversky was just becoming known among economists for his work on people's decisions. And so Tversky and Jensen are talking at this dinner, and basically everybody they talk about it, President Carter, Jensen says, God, what an idiot. Yeah, he doesn't do anything. And they start talking about money managers, and Jensen's like, what a bunch of idiots. They don't know anything. They start talking about Jensen's wife and her decision making. And I don't think he called her an idiot, but he was critical of her decision making. And so Tversky said, so let me get this straight. You think that basically everybody in the world is full of all of these behavioral flaws and make really bad decisions, especially regarding uncertainty. Yet you think when you throw them all together, it's always going to work out. That it always comes out perfectly, as if everybody was perfectly rational. And as the story was told to me, Jensen just sort of leaned back and said, Amos, you just don't understand. And I think Amos did understand. He was getting at this essential conflict in the way economists viewed the world, where they'd sort of realized that individuals didn't really behave in accordance with their theories, but they still were pretty reliant on everything working out as if they did. And their argument was always, well, for one thing, all these people's different flaws might average each other out. I don't think anybody believes that anymore. There are some consistent flaws that most people have. And so their other argument was always, well, at least in financial markets, you've always got these arbitrageurs, these really smart, well-endowed investors, with a bunch of money who are going to pounce on these inefficiencies and try to take advantage of them. And I think where the world of academic finance and economics has gone since then, since the late 70s, is that, if you're talking about the relative price of Coca-Cola stock and Pepsi stock, that's true. If you're talking about sort of overall big trends in the market and, long-term swings and bubbles and busts, it's actually really hard to make money betting against those. In fact, you often get killed betting. That's the whole idea of trend following, is that you actually can make money going along with the trend. And so constantly betting against it is really dangerous. You can value investing is this sort of long-term betting against the trend, but actually right there at the moment of a bubble, trying to make money off the fact that you think the bubble's going to burst. First of all, you don't know when it's going to burst. And second of all, you've got a bunch of clients who are going to be extremely dubious of your arguments and start pulling their money away probably at exactly the moment when it would be best to be pouring more money into the bet. And so I think there's this understanding now that at least at sort of a big macro level, that all, whether it's because of behavioral craziness or because of actual rational economic forces, markets overshoot. They go too high, they go too low. And you can't expect them to sort of get things perfectly right. And I'm talking financial markets, not product markets necessarily. You can't expect them to be getting the price right all the time.
Yeah, and I think, and you mentioned, some of the traders in my world, they would come back with the argument and say, well, the price is fine just like it is. We believe the price reflects everything, and we're just going to trade the price with no concept of value. So there's these interesting ways to look at these subjects, and you do cover them all, and it's very cool. So I do recommend people checking it out for sure. Hey, Justin, where's the best place for? I know we can give them your blog site, which is blogs.hbr.org/Fox. Where else would you like to send people? Your Twitter page? Where else can they go to check you out?
Twitter, I'm Fox Just on Twitter. And then I have sort of my personal site that sometimes I keep up very assiduously and sometimes I don't. Is it byjustinfox.com?
Okay. And you said your Twitter is @FoxJust, Just.
Yep.
Okay, Great. Cool. Hey, listen, I appreciate you chatting today. I think it's one of the first times I've done a conversation where someone just in a very kind of cool narrative, and your book is a lot more in depth than our conversation, but just kind of a narrative taking people through to get them thinking about how we've got to the point where we are today. And it's worth thinking about for sure.
Well, I think people come up with particular ways of looking at the world because they're in particular circumstances, because of the influences around them and because of, the way the markets are behaving at that moment. And I think one of the problems with the way academic finance presented itself in the 60s and 70s and 80s was, oh no, these are eternal truths. And they're not. There aren't very many eternal truths in markets other than, it's hard to keep beating them forever. And I just think it's actually, I love it partly because I like the stories, but I also think in sort of understanding where ideas come from, you can approach those ideas in a slightly more skeptical, but also just with more understanding of, oh, okay, that's why that guy came up with that idea.
I think if anybody got close to the eternal truths or has gotten close, to me, I feel like the behavioral guys have got there. It's something you can wrap your arms around. It seems like it's more robust. It's more connected to us as human beings. But that's just my humble opinion.
Yeah, and they just haven't been able to explain everything that goes on in markets and very often, they end up explaining 10 different things with one behavioral trait. It's fascinating, but it doesn't always provide any sort of clear answers of how markets work.
Well, as I mentioned, I get back to that comment from Vernon Smith, and he said it to me a couple times now, which is, we don't know why these bubbles happen. So right. I don't know. It'd be interesting to see by the end of our lifetime if anyone's figured out why bubbles really happen. Hey, listen, it was great having you on. I appreciate you taking the time today.
Thank you very much, Michael. It was a lot of fun.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.